Vicious in the Bank of Canada has kept its overnight rate at 2.75 basis points.
It's a pause. So let's bring in BNN Bloomberg's Paul Bagnell for more analysis on this. Paul, it was kind of a 50-50 split, but you were saying earlier when we chatted with you before the 7 o'clock hour that you thought most economists thought that they might cut. So what's the reasoning behind this decision?
Well, there is so much uncertainty, Nick and Jennifer, because of tariff policy in the United States. That the Bank of Canada thought the best thing to do currently was to not cut its benchmark interest rate. So it leaves rates alone. Its overnight rate, which is a very important interest rate in the Canadian financial system and economy, remains at 2.75%. Keep in mind that the prime rates that are established by major Canadian banks and lenders are derived from the Bank of Canada rate, and then a whole suite of lending products like variable rate mortgages, like auto loans, like lines of credit are based on those prime rates. So the takeaway for borrowers here is that there will be no near-term reduction in the rates that they pay on those type of loans. The bank makes it clear that it is worried about a slowdown in economic growth and an increase in inflation arising from the tariff policies of the United States. In fact, it's published today a document called the Monetary Policy Report, which is something that it publishes several times a year. It's a lengthy report. It runs 30, 35 pages or so, and it's an in-depth look at the Canadian economy and what the bank expects to be coming in the Canadian economy. And today, unusually, the bank provides two scenarios. Things are so uncertain that it provides two scenarios. And one of them is that there's a protracted trade war between Canada and the U.S. Canada's economy falls into recession in 2025, and inflation rises to above 3% in 2026. That is a pretty bleak outlook, but the bank is saying that is possible. It also says that in a scenario where tariffs are limited in scope, so something short of a full-blown trade war, Canadian economic growth will weaken nonetheless. So it sees a weaker Canadian economy ahead, and it says it's ready to respond to incoming data and is ready to cut rates if necessary, but has not taken that step today.
Okay, no adventure we want to choose.
Just curious, is that helping our dollar if there was expectation that it would?
I don't have a look at the dollar now. Just let me look at my BNN Bloomberg screen. I would think that the expectation was, as we said earlier, there was no clear view on what the Bank of Canada was going to do today. It was considered a coin flip. And so my guess is that the Canadian dollar is little changed right now. A cut in interest rates would have been dollar negative because lower interest rates tend to be negative for a domestic currency bill. So my guess is, I'm still looking for the loonie. I'm not coming up with it on my screen yet, but my guess is the loonie, which was the last time I looked at just under 72 cents U.S. likely is holding firm.
Okay, we know we'll get you there on BNN Bloomberg throughout the day with Paul Bagnell and the rest of the crew down there. Paul, appreciate this. We'll talk again tomorrow. Have a good day as you decipher what Tiff Macklin's saying.
Thank you, Paul.